Behavioral finance says that psychological influences and biases affect the financial behaviors of investors. As behavioral finance is such an integral part of investing, the SEC actually has a staff specifically focused on behavioral finance. The purpose of behavioral finance is to help understand why people make certain financial choices and how those choices can affect even markets, like the housing market. It takes into account all of the factors that go into decision making, emotions, biases, habits, and more. By understanding how people make financial decisions, you can make better decisions for your business or investment. Today's digital age has opened our eyes to individual attitudes and behavioral approaches to values, and investors have implemented this into their financial modeling. What most business owners and entrepreneurs don't understand is how finance is built on these theories and how they affect your decisions. The concept of behavioral finance is based on psychology. People are not all rational, and making certain decisions can hurt you financially in the long term. Investments, for example, are popular for behavioral finance because they're highly emotional. Who doesn't have a risky investment story from several years back? Even when the market is in the lowest, some investors don't get out of a bad investment because emotions were on their side. In behavioral finance, decision-making is heavily influenced by external factors. We don't just make decisions because it makes sense to us. We also do things to confirm what we want to be true before making a decision. Something that someone once told you or you heard at a conference, and so on. We have a tendency to do this with both financial decisions and business decisions. You are more likely to invest in a venture capital fund if you know there are people who believe it's worth investing, since investing is an acceptable risk to them. People will say it's an okay risk since they're already into the risk of investing their own money, so it means they're willing to do the same for theirs. As people are willing to pay for something seconds before it will be put out there, they're going to be willing to pay for something that anyone thinks will pay off in the end. So this means you're more likely to get investors if you say it's worth it, even if you don't think or believe it or think that there's a chance it fails for these investors. There have been hundreds of research studies on the cognitive biases leading to irrational investment decisions. And we see this with the public news on failed investments, bad deals, bankrupt business. I'm only here to equip your mind with the knowledge and satisfy those biased emotions. There's risk in every financial decision you make, and your decision to invest is personal and based on a lot of internal and external factors. So be careful when making those decisions.